very respected speaker of this evening, CA Vikram, and senior members, friends, CRC technical head, who is a very dynamic person, Mr. Silva. Very good evening to all of you. It is very heartening to be back to interact with our members this evening on the occasion of the workshop series on accounting standards for non-corporate entities. Let me thank the chairman of SIRC and my good friend CA Chinnamastan for giving me this great opportunity to be amidst our professional gathering. I have been bestowed with the pleasant assignment of welcoming the resource person and other participants to this evening program. I at the very outset congratulate the present team under the leadership of CA Chinnamastan for conducting the affairs of SIRC with the excellent programs. You will appreciate that the present team leaves no stone unturned to bring to the members diverse subjects of professional interest almost every day. This month itself, they had conducted various workshops on the subject of accounting standards, auditing standards, and FEMA, besides the National Conference of International Taxation, and other subjects of significant importance and interest. It is gratifying to note that SIRC is joining with various other central committees in many of the programs of SIRC. Overall, the members would have noticed that the programs have been embedded with interesting and informative areas of professional interest. The vibrancy with which they are performing, the entire team deserves high applause. At the same time, I also witnessed the continuous and encouraging participation from our members, which I happily record at this great occasion and express our sincere thanks to them. SIRC looks forward to our continued support for the success of all the programs of SIRC. With this, I deem it my great pleasure and a privilege to join with the participants to extend our warm and hearty welcome to our erudite and esteemed resource person CA Vikram to this evening program. SIRC is grateful to him for accepting our request with short notice to share his rich experience and exposure on the subject of discussion for today, the AS 22 and AS 29. The 5-day series of on accounting standards for non-corporate entities had a phenomenal response. I, on behalf of SIRC, offer our warmest welcome to the participants who have come to get enlightened on the subject which impact our professional service in relation to the complaints of accounting standards for non-corporate entities. As you are aware, the objective of Accounting Standard 22 on taxes and income is to prescribe accounting treatment of taxes and income, since the taxable income may be significantly different from the accounting income due to the various reasons. The objective of Accounting Standard 29 relating to the provisions, contingent liabilities, and contingent assets is to ensure that the appropriate recognition criteria and measurement basis are applied to provisions and contingent liabilities, and that significant information is disclosed in the notes to the financial statement to enable users to understand their nature, the timing, and the amount. The objective of this standard is also laid down the appropriate accounting for the contingent assets. The seasoned speaker of the day would be giving an overall perspective of key provisions on these two standards, the process of accounting treatment, adherence to the disclosure requirements. I'm sure the participants would have the benefit of his exposure and expertise and help in updating their knowledge. At the end of the day, you will all agree that you had an invigorating and interesting session and feel worth the time spent this evening in enhancing your skill. Friends, today's speaker has a mission of championing of developments in the assurance sector with a passion for newer and challenging opportunities. He is instrumental in firms consulting and advisory services in India's reporting and financial controls review. He brings the knowledge, experience, and expertise with the proficiency through a professional career spanning 12+ years of experience. He has led various prestigious assurance and advisory engagements for large corporate clients in financial services, manufacturing, textile, retail, and real estate sectors, with the added experience and exposure for entities listed in the Stock Exchange of India. He has been invited at various forums to conduct sessions on subject relating to Ind AS, IFRS, and other related topics. His area of specialization includes statutory audit, Ind AS, IFRS, US GAAP reporting, and a consultancy on financial reporting and internal controls review. He has worked extensively with multinational corporations and Indian groups. Is an experienced auditor with extensive experience of reporting to the board, audit committees, and interacting with the senior management. With these few words, I have great pleasure to introduce today's speaker, C.A. Vikram, and once again offer my warm and heartiest welcome to the speaker and all the participants to this excellent program. Thank you so much for this great opportunity. Over to the speaker.
Thank you, sir. Thanks for such a great welcome. Really happy to be part of the SIRC, and of course it matters a lot for us. SIRC is like a parent organization for us, and I remember those days where when I wanted to do CA, the first thing what I had to do was send my application to Chennai SIRC. So it was at the moment I was asked to take this session. For me it was a kind of achievement that from the time I tried applying for chartered accountancy, at that time it was P1, and now institute has given me everything. So thankful to the institute, thanks to the whole community which is there for me, which made a good profession. This profession has given me everything, and thanks to my firm for letting me take this session. Thanks to my firm Suresh & Co, where even though it is one of the I would say a strong day, I would say a busy day, and I'm able to come and discuss with my peers. I'm sure end of this session all of us will learn more. We will understand what are all the basic things which we consider in any of these standards. The whole session I would like to take it in, I would say, a 3-module strategy. One, we would like to understand the basics of the standard. Of course, the topic itself is for non-corporate entities. One thing which I thought was, let us also relook at couple of paragraphs of the standards. Many a times it so happens with the experience thing, we try to jump certain paragraphs. So keeping that in mind, I would like to go through the paragraphs once. Then I'd like to take up a couple of case studies which may be important for any practicing chartered accountant, followed by a question and answer session. In between, if anybody wants to raise any query, please let us know. I'll be more than happy to take the session. And with this, I guess I'll be able to share my screen. Let me just share my screen. Please advise if it is visible. Is it fine, sir?
Not yet, sir.
Good, sir. Selvam, please help me. Yeah,
now it's visible, sir.
Fine,
visible.
It's visible.
Now it's showing the desktop screen. You need to navigate to PPT.
Is it fine now?
Yeah, now it's fine. PPT. Fine, sir. Fine.
You can go.
Fine, great. So during today, rather in this next 2.5 to 3 hours session, we'll be discussing on certain finer aspects of both Accounting Standard 22 and Accounting Standard 29. Starting with Accounting Standard 22, and more than that, would like to discuss or rather share certain thoughts on how or why accounting standards matters a lot. Whenever we do our audits, one of the basic things, both as an auditor or as a stakeholder, what gets into our mind is assertions. So we always presume and believe that the financial statements have been prepared as per the guidelines, which is in general called as GAAP, the general accepted accounting principles, plus the assertions. Assertions plays a very important role in any financial statement, equally with the GAAP. And for anybody to have a hold on assertions, it is vital that they are aware of the principles and rules which guides the accounting standards. We all know Companies Act has a specific section where accounting standards has been brought into the Companies Act, and thanks to our institute, the entire accounting standards, whatever accounting standards we have, has been developed by the Institute of Chartered Accountants of India, which has been taken by the Companies Act. When it comes to companies, there is a specific section which requires the entity to comply with accounting standard, and any non-compliance may lead to issue as far as the compliance of section is concerned. An auditor will have to comment on the same. When we come to non-corporate entities, per se, there is no guidelines or there is no act which prescribes how companies are, how accounting standards to be followed or what sort of guidelines to be followed. So there were certain challenges when someone is reading the financial statement of a non-corporate entity. It may face some challenges for the readers to understand or at least to know whether they are compliant with accounting standards. Imagine a scenario where the financial statements has certain concepts. Say for example, there are it's a non-corporate entity which has say around 300-400 employees, and if the financial statements does not give details about employee benefits, post-employment benefits, maybe like gratuity, maybe like leave encashment, maybe like ex gratia, if at all the entity has, but still if it is not appearing on the financial statements, the reader of the financial statement, the stakeholder to be in specific, will not get the exact picture of the financial statements. Something which needs to be kept in mind, the stakeholder does not specifically, or it is not limited to the regulators like income tax or GST. It goes beyond these regulators. Say for example, if the entity wants to borrow money from lenders, financial statements is the only source which can actually give a hint on the financial status of the organization. Say for example, someone wants to invest on the enterprise. If the investor is in the process of investing on the enterprise, for that investor, it is very much important to understand how the financial statements have been drafted, how the financial statements have been prepared. And in such scenarios, whether in the course of investment as a mergers or amalgamation, or in the course of lending money, or many a times it may so also happen, the vendors, the creditors, or the customers, the debtors of the company may sometime will be interested to understand the financial stability or financial status of the organization. For them also it matters if the financial statements are prepared in line with the accounting guidelines. So keeping all these things in mind, our institute has come up with these accounting standards, and again these non-corporate entities can be divided into various levels. There are a couple of levels which has been defined. I'm sure you all would have gone through this during this session. Coming specific to AS22 and AS29, what we are going to discuss today, there are no much difference between the levels. Across all the levels that remains the same, except for level few of the levels where disclosures of accounting standard 29 may not be applicable. Otherwise, per se, whatever is AS22, AS20, which is generally applicable to corporates, are equally applicable to non-corporate entities. So what exactly is taxes on income? Why should we have an accounting standard which speaks about taxes on income? The whole reason for having this standard is to bring a kind of uniformity amongst the books of account. There may be some situations, there are various factors which affects the taxation of any organization, and the profit what they display on the books of account, on the financial statement, may not be exactly the profit which will be accepted or considered as per the requirements of income tax. And as a stakeholder, it is important to understand where exactly the entity is paying more taxes or where exactly the entity is saving on taxes, and to bring a kind of uniformity amongst the entities, this accounting standard income taxes has been prescribed, and this is one of the oldest standards and one of the important standards which generally gets complied or which has various implications on operations of the rather disclosures of the company. This standard speaks more on income taxes. We do not speak anything on GST or excise duty. It is more on the income taxes. The whole, wherever I talk about taxes here, includes only the income taxes. Further, it also includes the taxation paid both in India and outside India. When I say outside India, what exactly I mean here is, say for example, there is an entity operating from India having a JV or a subsidiary outside India, and for various reasons the entities needs to be consolidated, the financials needs to be consolidated. The type of taxation what we have in India need not to be the same which would be applicable, say either in Sri Lanka or any other country. So when you consolidate the entities, it is very important that you give consideration for tax regulations of those countries also. And keeping that in mind, our AS22 does bring in the requirements to be complied when you are consolidating the financials. The whole objective of this standard is again dependent or again running around the basic principles of accounting, which is a concept of matching. How exactly this works? Say for example, an entity has incurred an expenditure, but the entity has not performed the obligations which is backed with that incurring. And in that scenario, under income taxes, you may not be eligible to claim the deductions. Nevertheless, under AS22, we may be able to create a deferred tax asset towards that. And to that extent, even though in the current year I am paying more taxes without getting the benefit of expenditure, I still end up creating a deferred tax asset so that my expenses, income tax expense, whatever I have accounted in the current year, is matching with the income or the revenue which has been accounted in the current year. Imagine a scenario where in 1 year there is a huge income, and on which there are also disturbances of expenditure. You may end up paying a taxes. The effective tax rate may be around 40% or 50%. And the next year you are able to claim a couple of deductions, and thus results in lot of additional deductions available under income tax, where income tax rate drastically comes down. If you compare two different years, in the first year your profit was 100, the second year also your profit is 100, but in the first year you had a couple of disturbances under income tax which resulted in tax maybe around 40-45%. So you would have paid 45 rupees of income tax. In the second year, since you have complied with whatever you had not in the first year, you start getting the benefits of those, and even though the profit is 100, you are able to get the benefits of the extra years 15, and the net tax what you pay could be as minimum as 15. So when you compare these 2 years, even though the revenue is same, the tax rate changes, and this may give a wrong impression on the readers, or stakeholders may not be able to understand it. So in order to avoid this, this standard has been brought in. And there could be various reasons why the tax profit may differ from book profit. Over the next couple of slides, I'll take up few of the examples which actually gives us an idea as to what these differences could relate to. One of the things, as each one of us know, whenever an asset is acquired by the entity, as per the applicable guideline sections in the Income Tax Act, irrespective of the date of put to use, we just go by one clause where whether it has been used for 180 days or less. If an asset is used for a period of less than 180 days, the assessee is eligible to claim only 50% of the depreciation as prescribed. On the other hand, under books, under the accounts, the assessee may be following depreciation based on actual days for which it is being put to use. And across the entities, the major difference may come under depreciation. And also the second thing could be the rate of depreciation what income tax allows, and the rate of depreciation or the life of asset which is exactly being used by the organization may be different. Imagine a scenario, the rate of depreciation for computers and related equipments may be 40% in income tax, but the entity may be able to use it only for 3 years, and entity would like to amortize it over 3 years. So in that scenario, definitely there will be a difference between what is being allowed under income tax and what is being claimed in the books of account, which results in a difference between books vis-a-vis income taxes. Now we will try, and first thing what we understood was there may be certain differences between books of account and income taxes. So what these differences are? Few of the differences could be something, say, as simple as depreciation. As per income tax, the depreciation may be allowed at 20%, 25% or 40%. As per books of account, the depreciation could be 30% or 35% or 40%. When in intangible assets, as per books, we may amortize over at a straight line basis over, say, 4 years or 3 years, which means to say if it is 3 years, they may amortize at 33.33%. Whereas in income taxes, you may be eligible for only 25%. So there is a difference between the depreciation between the books and for income tax purposes. However, the basic expenditure which is being incurred, if I have spent 1 crore rupee on acquiring an intangible, that 1 crore rupee remains the same. What differs is the way in which it is amortized over the period. In the income taxes, it may get amortized over 8 years or 9 years, whereas in books of account, it may get amortized over 4 years or 3 years. At the end of this tenure, whatever was being spent to acquire this asset gets allowed as depreciation. So if you take overall picture from year 1 till year 10, at the end of year 10, both under income taxes and under the books, you would have claimed the depreciation or amortization, to be specific. And this difference can be termed as temporary difference. Mean to say, there is a temporary difference between the books of account and income tax purpose, and this difference gets adjusted over a period of time. In this example, as per books, it gets completely amortized by year 4th, and year 5th onwards, there is no depreciation in the books of account. Whereas under Income Tax Act, the major portion of the assets gets amortized over, say, 9 years or 10 years. So even after 4th year, where there is no depreciation in books, still under the block of asset concept, and yet by income tax, we still continue to claim the depreciation. And this is called temporary difference, because no matter what, your total amount is being recovered, but it may be over a separate period. On the other hand, permanent difference is something where there is a transaction which has happened with the entity, and that transaction will not get mirrored in the income tax purposes. So what exactly I meant by it's not getting mirrored in the income tax? Imagine a scenario where company has incurred an entity, sorry, I used the word company, an entity has incurred an expenditure which is they have made some payment using cash. We all know if an assessee makes any payment using cash in excess of the limits prescribed, that expenditure gets disallowed. As a tax auditor, you may disclose that, and under section 40A3, the assessee is required to disallow the expenditure. Imagine it is around rupee 1 lakh. Here he happened to make the payment using cash, and income tax disallows it. Can he claim that whatever is disallowed forever? There is no way that the assessee can get the benefit of that expenditure. The objective of law is very simple: to avoid transactions which can be hidden. So if at all a transaction happens through bank, it is easy to identify and locate the transaction, or identify the seller and buyer, or service provider and service recipient. So the government has, rather the regulator has brought in this provision where the entire expenditure gets disallowed. However, in the books of account, this 1 lakh continues to be an expenditure, and he will still be showing his profits after the 1 lakh rupees. And this kind of expenditure, which can never be allowed to under income tax, is considered to be a permanent difference. Like this, you will get to see lot of activities which may be permanent in nature. It may be like a penalty which someone is forced to pay as per the required regulation. A penalty is something generally being claimed by the regulator for any non-compliance or any activity which is not allowed under the act. And if a penalty is paid, income tax will say that much of expenditure you cannot claim, because it is not, you are not supposed to go against the law. And if at all you go against the law, there is a penalty. In order to mitigate, in order to stop someone from taking action or doing any activity outside the scope of law or outside the boundary, they have said these penalties will be disallowed. So these it may be another, the penalty is another matter where it will never get allowed under income tax, and you may lose out the benefit. There could be another biggest scenario which may happen. Generally, it happens for entities which is a new entity, rather entity which is yet to start its operation, or a new entity. When you incorporate a new entity, or when you start a new entity, you may take, the assessee may take some time to start the commercial operations, and until then the entity may incur some expenditure, and which is generally termed as pre-operative expenses. And there are various views. One set of views says this expenditure needs to be disallowed, and if you follow that view, where you take a stand that such expenditures are not allowed as deduction, and you will not be eligible to carry forward it as a business loss for subsequent years, and if you disallow that, again this expenditure becomes a permanent difference which can never be claimed under the Income Tax Act. These are all the few examples. Why knowing permanent difference is important is, while computing deferred taxes, we will exclude those items which are permanent difference in nature, and we do not compute the deferred tax asset on such expenditure which never gets allowed as deduction. One thing to be kept in mind, deferred tax asset is always beneficial to the assessee. Whenever he creates a deferred tax asset, he is actually giving a credit to the profit and loss account, and he is creating an asset which can be utilized in subsequent years. And if at all there are certain expenses which are permanent in nature, and on such expenses you cannot accrue deferred tax asset. As I explained, preliminary expense is another such expenditure. As all of us know, there is a section called 35D under Income Tax Act where it allows expenditure to be claimed on a periodic basis. Another section could be 43B under Income Tax Act. This section is one specific section which actually allows assessee to claim the expenditure as deduction only when the expenses are actually paid. Mean to say, even though the concept which income tax law uses in general is accrual, all the expenses, if it is accrued, it is allowed as a deduction, and that's one of the basic principles which governs income tax. But except for section 43B, where it is very clear that certain expenses like statutory bonus, interest from banks, financial banks and NBFCs, gratuity, leave encashment, and similar expenses. Our last one being any cess or duty which is payable to any regulator. These kind of expenditure will be allowed as a deduction only when you actually pay. Imagine a scenario as per accounting standard 15 or as per the guidelines which the entity is following. Entity would have accrued gratuity, and we all know gratuity is paid only when an employee quits the organization and if he has also completed 5 years or 4 years and 8 months as the case may be in the entity. Otherwise, payment of gratuity act may not be applicable and the employee may not be eligible to claim the gratuity. Just because the gratuity has to be paid after 5 years, it does not mean that you will not accrue gratuity until an employee completes 5 years. You still accrue gratuity from the day an employee joins your organization. And when you accrue this gratuity, you will not end up paying year on year like any salary or incentive or any other employee welfare activities. You accrue it and you create a liability and you pay it as when a person leaves. When you accrue gratuity, your profits are reduced to that extent. When profits are reduced, obviously your tax amounts should also reduce. But in income tax, you add it back, and on that you compute your income tax. And since gratuity is allowed only on actual payment basis, at the end when you make the payment, it is allowed. So this is a scenario where there is a temporary difference in the expenses between the books of account and income taxes. So gratuity falls there. The second thing could be bonus. The bonus which is not allowed under 43B is basically the bonus which has to be paid under statutory requirement. If the bonus is in the nature of incentive, which is as agreed between the employer and employee via their offer letter, and it is connected to the performance of individual irrespective of the percentage. If it is connected with the performance, then that can be considered as incentive and not bonus, and such incentives are generally allowed on an accrual basis. And when incentive is accrued on an accrual basis, there does not exist any timing difference because under Income Tax Act it is allowed, and under books of account also it may be allowed. But on the other hand, if it is bonus under Payment of Bonus Act, where they would say a fixed percentage to be paid irrespective of the performance of individual, then such amounts are allowed as deduction only when the assessee actually pays that money to the employees. Let us take one example here. Imagine a scenario. As on 31st March, you have accrued bonus, and under section 43B, you have time to pay this bonus until the date of filing your return. So the date of filing return could be October 31st. Your books of account is prepared till March 31st. And when you close the books of account, you need to have a proper assertion and you need to have an understanding whether this bonus gets paid in next 6 months or no. Generally, in majority of the entities, organizations in India have this habit of paying bonus on the date on during Deepavali season. So if Deepavali season happen and you are consistently assuming you are making the payment during Deepavali, and Deepavali comes assume before October, then as an accountant or as an auditor, you have a option not to consider this bonus as a temporary difference and still claim the deduction without creating deferred tax asset. But on the other hand, if you do not have that much of evidence, then on this bonus you have to disallow under in the books of account, in the income taxes, and to that extent you need to create a deferred tax asset. Similar way, interest is another situation where unless and until you pay the interest, you will not be allowed as a deduction. As an auditor, it is important when you review the financial statements, please look at this case where whether interest accrued is paid or unpaid. If interest accrued and it is unpaid, the assessee will be showing it separately in the books of account. There is a separate disclosure under income tax return also, interest accrued but not paid. And on that, if you have to disallow that interest and create deferred tax asset on that. Similarly, another example could be decline in the value of investment. As we all know, as per accounting standard 13, if the investment whatever you have done on stocks or shares, if the value of investment is reduced, then you create a provision for it. As of now, if you see the way last 2-3 months the market has been very volatile and there has been a reduction in the Nifty and Sensex, and that would have impacted lot of stocks and shares. So as on 31st March is very important for an auditor to assess whether this decline is temporary in nature or permanent in nature. It has to be done on individual asset basis, and assuming after that, if you believe that there is a impairment in the asset, that will be debited to the P&L as loss. That loss will not be allowed under income tax in the year in which you accrue. It is allowed only when you realize the loss, realize the asset, in the sense asset was written down as on March 31st, and say by April or May, if you sell that asset, sell that investment at a loss, then only that loss is allowed as deduction and not this movements in the investment. And in that scenario, you end up creating a deferred tax asset on such reduction. Few examples of permanent difference, as I said, penalties is one major example. Then donations, if a donation is not allowed as deduction, that is another major thing which can generally happen in any organization, which may be debited to P&L but do not get allowed as deduction under Income Tax Act. And such differences which are permanent in nature will be allowed as will never be allowed as a deduction, and hence you don't have a, under this accounting standard you cannot create deferred tax asset on such difference. Couple of definitions which we have to be well aware of. What exactly an accounting income or a loss is. In simple term, accounting income or accounting loss is nothing but the loss appearing on the financial statement, appearing on the statement of P&L or appearing on the profit and loss account. Taxable income or taxable loss, very simple. Whatever the tax income, whatever the profit you arrive at after adjusting allowances and disallowances as per the provisions of income tax. So whatever gross total income you define or you present in the income tax return is taxable income. Tax expense or tax saving is basically the sum of current tax and deferred tax. Current tax is the tax which I pay as per the income tax requirement. Deferred tax is that which I either create or reverse as per the requirement of AS 22. In any financial statement, an assessee is required to show the taxes under these two liners, current tax and deferred tax. And the sum of this current tax and deferred tax plays a very important role. And it is one of the important ratios which as an auditor you can consider. The thumb rule here is if my turnover is 100, the sum of current tax and deferred tax should be equivalent to 30%. Maybe for non-corporate, the tax rate could be 30%. I'm ignoring the surcharge and cess here. Assuming the tax rate is 30%, then the tax expense should be 30 rupees here. If the tax expense is something different than 30, then as an auditor, we need to check, are there any errors in the computation? There may be few errors, there may be few permanent differences. If errors are not there, then the differences will be nothing but the tax rate on permanent difference. To put it very simple, let us imagine the profits as per books is 100 and sum of current tax and deferred tax, which is as shown in the financial, is say around 45 rupees. So the tax rate is net effective tax rate is coming to 45% against 30% which is allowed. So what could be the reason? If we go in depth, there could be a possibility that there may be few expenditure which is being incurred but may be disallowed under Income Tax Act. Imagine under 48(3) you would have disallowed, gratuity under penalty you would have disallowed. Maybe a scenario where under section 40B it is not completely allowed as remuneration, so that might have got disallowed. This could be the various reasons for disallowances in income taxes, which gives you an additional income tax charge. And as an auditor, we need to have a proper reconciliation to substantiate that the differences in tax rate matches with the books of account and matches with the work paper which is being prepared. Just to explain this is a small table where EBIT was rupee 1 lakh and as per the books I should have paid 30,000, whereas as per our records, what they have actually done, instead of reducing 30, they would have reduced interest. Imagine a scenario, there is an EBITDA which is actually at 100. There is an interest of 20,000 and PBT is 80,000. On 80,000, there has to be 30%. If at all it is 30% tax rate, 24,000 should be the tax amount. Whereas if you actually see the way it has been done, they have provided a tax rate or they have paid a tax amount of rupees 30,000 instead of 24,000. If you go in depth, you will understand 20,000 is the interest amount which is not allowed as deduction under income tax and hence added back under income tax, which is resulting in an profit of 1 lakh, and on that they have paid taxes at 30. So this balance 30,000 minus whatever the tax which is actually paid gives us the reason for deferred tax or leads to deferred tax asset. This I have explained. Recognition. How should tax expense be recognized? Tax, it has to be disclosed in the P&L. It has to be recognized in the statement of profit for that period in which it has been accrued. Sorry.
Sir, your PPT.
Yeah, clean, right?
Yes, sir.
Yeah, sorry. So deferred tax assets or deferred tax liability, as I explained, is only for timing difference. The way in which an accounting entry is passed is whenever there's a deferred tax asset, we will debit deferred tax asset and we will credit profit and loss account. Going by the simple definition or simple logic, all assets will have debit balance, all deferred tax assets should have debit balance. On the other hand, deferred tax liability will have a credit balance. At that scenario, we will debit profit and loss account and we will credit deferred tax liabilities. Now, one of the important things which we need to consider, can we recognize deferred tax asset in all the cases? Wherever there is a deferred tax asset, wherever there is a difference between income tax and books of account, can the assessee, can the trader, can the entity recognize deferred tax asset? Two things to be kept in mind. Deferred tax asset cannot be recognized in certain scenarios where under income taxes there are certain regulations which restricts you to use your carry forward losses or restriction on certain activities. One thing which we need to keep in mind, why are we recognizing deferred tax asset? We are recognizing deferred tax asset with an objective that even though today I am not eligible to claim a deduction, in future I will be eligible, and hence I create a deferred tax asset today. And many times we also do create deferred tax asset on carry forward of losses. Imagine that there is a carry forward of loss and we still start creating deferred tax asset. Say for example, there is a difference in the depreciation or there is a disallowance in the expenditure and I have created deferred tax asset, but the company has been consistently following or consistently incurring losses. When a company is, when an entity is consistently incurring losses, what we need to see, how can I use the deferred tax asset? At some point in time, this deferred tax asset should help me to pay lesser income taxes. Means to say, I should end up with a taxable profit. And if the past outcome tells that assessee takes a longer period to earn profit, then that itself gives a kind of evidence that whatever asset you create may not be eligible to be claimed as deduction in future. Example, assume the assessee has a carry forward losses of say around 30 crore or 40 crores, and every year it is incurring losses. And even though if it starts making profit, it takes maybe 10 years or 12 years, and the assessee has created deferred tax asset on the depreciation, sorry, business loss. And all of us know business loss can be carried forward only to the extent of 8 years. And the losses what company has made is so huge, even after 12 years, that losses cannot be completely utilized. In such scenario, it is not allowed for you to carry forward the deferred tax asset on for that period until the entity makes profit or until there exists a virtual certainty that entity will make profit. And virtual certainty is very I would say person has to be person has to use his judgment to decide whether there is a virtual certainty. For few people, if you see all these startups, say for example, there's a startup which has just an entity which has just started its operations, and the revenues are very less vis-a-vis the cost which they are incurring. At the time you close the books of account or when you do the audit, you may not be certain and you will not be in a position to tell when can this company, when can this entity makes its first revenue, or when can this entity earns its first profit. In such scenarios, it is advisable not to create a deferred tax asset, or in case if an assessee has created deferred tax asset, you will have to advise them to delay creation or reverse such asset which is being created. Reassessment of deferred tax, unrecognized deferred tax assets. Say for example, last year the entity's future was not looking so bright, and this year the future looks amazingly good. Let us take an example. Last year, because of COVID, many people start using technology, and the assessee was into building a technology which is being consistently used by technology platforms, and their initial investment was so huge, and as an auditor we didn't have evidence to say for next 3 years or 4 years they will make profit. But in a span of 1 year or 2 years, because of increased usage of technology platform by users, the demand for the product might have increased multiple folded, and the entity would start making profits from this year, in the sense 21-22. In that scenario, whatever you had not recognized, assuming you had not recognized deferred tax asset for first 2 years, and now since the entity has started to make profit, you should create such deferred tax asset which is retrospectively. So there is a certainty which has come, and you start creating the deferred tax asset. So it's not that once you fail to recognize deferred tax asset, you can never recognize it. It does not happen like that. It's a balance sheet item which gets on, where you keep on assessing and reassessing for every reporting period whether asset really exists, or whatever was not existing, can I create the asset today. So that has to be done on a year-on-year basis. Measurement, coming to measurement, always current tax is measured using the applicable tax rates, and deferred tax are measured using the tax rate which was enacted as on the balance sheet date. Means to say, whenever we close the balance sheet now it got closed in March 2022. By March 2022, we know what is the new enacted tax rate. February 2022 is when the budget has been announced, and if at all there are certain changes in the tax rate, while computing deferred tax, you consider that whatever was proposed and accepted in the budget. If there is a gazette which has accepted it, then you will consider that rate, assuming it was 30% before. As for assessment year, say 22-23, the tax rate was 25%. For assessment year 23-24, if the tax rate has been reduced, then for computing deferred tax, you will go by whatever has been enacted as on the balance sheet date. One thing to keep in mind, deferred tax asset or liability can never be discounted, even though if someone is following a discounting principle for disclosing their assets and liabilities. Deferred tax can never be discounted. Now, is the opposite thing to what we have discussed in the earlier slide. Assuming you had created a deferred tax asset, what should you do in the subsequent years? Just because you create a deferred tax asset in 1 year, it is not that that asset will continue to be disclosed in the balance sheet year on year. It is mandatory as a chartered accountant, as an auditor, to assess whether that asset really exists. Means, like any assertion, one of the basic assertions what we have learnt or understood is the completeness and the accuracy. If an asset you have disclosed, imagine a scenario where you had disclosed an asset, say a tangible asset, and due to wear and tear or due to change in the technology, that asset has been impaired. Similar way, we should do impairment testing for deferred tax asset. Let's imagine a scenario where we had created deferred tax asset on, say, a particular disallowance, for example, a gratuity, or rather say bonus. you had accrued liability for bonus, and for various reasons your assessee decides not to pay the bonus, and at that scenario the asset does not exist anymore, because that bonus will never be deducted if you do not make the payment. And if you have an evidence to say that can never be deducted, then you have a question, how should you, what makes you to claim that deferred tax as an asset? Similar way, you had created deferred tax asset, say on the depreciation part or a carry forward loss part, and you get some evidence to say that at the last balance sheet you have a reasonable certainty that there will be appropriate assets which appropriate profit to claim the losses, but now you get to know the company has gone into certain other activity and there can't be any possibilities of making profit. At that time you will reverse whatever the asset which was being created. You will debit the deferred tax into the P&L and you will credit the deferred tax asset which was there in the books of account. And these kind of either write down or reversals as we discussed here in this slide, and the write down what if at all we had to do earlier, this has to be done only when there is a virtual certainty. There are a couple of explanations which have been given in accounting standard. Let's imagine a scenario that there is an entity which has been claiming benefits of taxation under SEZ. Means they have incorporated their entity in a special economic zone and they are eligible for 100% tax exemption on the profit what they have made out of exports. And say this is eligible for 5 years or 6 years or 10 years, or let us assume for 5 years. For next 5 years, this assessee is never gonna pay taxes. So how should we create a deferred tax? If you see the overall P&L, how it looks is when it profit say 100 and income tax is nil, because there is no tax liability. Of course, there may be an AMT. I'll not come into that, but assuming there is no AMT, then definitely income taxes will be nil. Should we create deferred tax asset? Because obviously the kind of, there could be some expenditure which is disallowable. So how should I create deferred tax asset? Can I create deferred tax asset from day one, or should I create deferred tax asset on a particular date? So as per the standards, as per the explanation given, it is very clear. You have to create the deferred tax asset keeping in mind what could be the scenario once the benefit is completely used. Means to say, let us imagine as on 31st March 2022, the entity has 5 years of exemption under SEZ. Then as per AS 22, you should, if at all, say assuming you have to create deferred tax asset on depreciation on WDV of asset, you will recompute the WDV as for the next 5 years. Today it is March 2022. March 2027 is the last month which is eligible for deduction. Then you will compute the WDV as per the books of account as on 31st March 2027. You will compute the income tax WDV as on 31st March 2027, and whatever the difference is, say it comes to around 50 lakh rupees. On that 50 lakh rupees, I am eligible to compute deferred tax asset. On 50 lakh, maybe 30%, I'll end up with 15%. Today, the difference could be accrued. And if I need to compute deferred tax asset today, it will be 30 lakh. But we cannot create 30 lakh because even though there is a difference today, the difference gets adjusted to the extent of 50 lakh as on 31st March 2027. And only balance 50 lakh is remaining at the end of 31st March 2027, which is eligible to be adjusted. So we compute deferred tax only on that amount which will remain at the end of the beneficial period. Transitional provision, whenever an entity has to apply accounting standard 22, how should you apply that? So what exactly gets done in that scenario is, a retrospective approach will be done. A simple example could be WDV of asset. You will consider the WDV asset as of the date of balance sheet, as of the date of reporting. On that, you will compute the deferred tax. If it is the deferred tax liability, and you will adjust it with the profit balance in the revenue reserves. If revenue reserve does not exist, you will adjust with the balance in profit and loss. And no matter the deferred tax liability can be adjusted with any other premiums. Disclosures, always deferred tax comes after, in the P&L, deferred tax comes after profits, net profits, and in the balance sheet, deferred tax asset is shown separately in the balance sheet. It has to be shown separately from long-term loans and advances and investments. Either deferred tax assets or deferred tax liability is shown separately. And it's also important when in balance sheet, we also give disclosure what are all the components of deferred tax asset. Means to say, if deferred tax asset is rupees 25 lakh, what and all items has led to creation of this deferred tax asset? One standard thing could be WDV, which is depreciation. Second standard thing could be employee benefits, gratuity and leave encashment. Third component could be these 43B items, and like that there could be various things. So we need to give a breakup. 25 lakh is my deferred tax asset. Out of that, 20 lakh is because of difference in the WDV, 3 lakh is because of difference in the gratuity, and 2 lakh may be because of certain expenses which are not allowed under section 43B. And adjusting DTA and DTL, I will not go much into this. There is basically, it says a legal enforceable right. I'm not seen much in my practical thing also. It's not something which comes, except of course we do this, all the assets and liability we merge together. If say for example, what gratuity may lead to deferred tax asset, depreciation may lead to deferred tax liability. Should I show deferred tax asset for gratuity separate, deferred tax liability for deferred tax asset for depreciation separate, deferred tax liability for gratuity separately? No, we don't do that. We merge both. There could be excess expenditure claimed under Income Tax Act. There could be lesser expense claimed under income tax. Both together they come and net deferred tax is computed. The issue may arise when the entity in India has a subsidiary outside India, and there exists in both the entities, there exists deferred tax assets and deferred tax liability. Assume the subsidiary has deferred tax liability and the parent has deferred tax asset. The parent's deferred tax asset could be because of losses which has been consistently incurred in the parent, and subsidiary may be making profits. In this scenario, we cannot adjust the deferred tax asset of parent with the deferred tax liability of the subsidiary for a very simple reason. Just because I have profits in parent that cannot be adjusted, I have losses in parent that cannot be adjusted with the profit of subsidiary, and hence we cannot net off these two. So few case studies or few audit checks which we need to have while reviewing deferred tax asset. One is average tax rate, which I told. Whenever you close the balance sheet, whenever you close the P&L, please make it a point that you will compute net profit. On the net profit, you apply your tax rate, say 30% or 35%, whatever is, that should give you a tax expense. Means current tax plus deferred tax should be equivalent to 30% of the net profit. If that is not 35% or 30%, as the case may be, then you need to go deep and analyze what caused the difference. Why is that 35% not matching? Second thing which basically appears in section 35D and maybe in research and development, say if an entity is, assuming an entity is into research activities, and because of research activity they are spending say huge amount on research equipments or research expenses, either revenue or capital. And as per income tax, whatever is spent on research under 35(1)(4) research capital, if it gets 100% allowed in the year in which it is actually incurred. But under Income Tax Act, even though you have incurred 1 crore rupees on your plant or equipment, you will claim it under straight line, say for example, over the next 4 years. So there exists a difference. Under 35(1)(4), if you are claiming it 100%, please make sure you create a deferred tax liability. Here it is a liability because you have claimed 100% now, but you will, in your books of account, you will claim it over a period of time. The other impact which generally has, other transaction which generally has an impact is, imagine the entity has sold its asset, and once the entity sells the asset, it will account the profit or loss in the books of account. Say for example, it's a vehicle which the entity had, and vehicle has been used for 4 or 5 years. The promoter or the partner decides to sell off that asset, and in the books of account the value of that asset may be say 3 lakh rupees, and you sell it for say 4 lakh rupees. What you will do, you will account 1 lakh rupees as a profit, you will pay GST on 4 lakh, you will account 1 lakh rupees profit, and you will show it as profit in the P&L as income or profit from the sale of asset. On the other hand, when it comes to income tax, this sale of asset will be treated separately as per the block of asset concept. Unless and until the block ceases to exist, you will still continue to claim it as a depreciation. In this case, what happens? This entire sales consideration of 4 lakh will be adjusted against the block of asset in income tax, and there won't be any profit or loss on sale of asset appearing in your P&L. This leads to a temporary difference, and we have to make sure on such profits or losses you have created your deferred tax asset. Even though you have generated profit in the books, while computing income taxes, you don't offer that profit to taxation, and you will still continue to claim lesser depreciation. What exactly is happening is that entire profit is not taxed, but you are claiming lesser depreciation year on year. To that extent, you will have to create the deferred tax. The other thing could be wherever there are additional depreciation. In case it may happen in couple of other states, there are specific states where the additional depreciation is allowed. That is temporary. It is not temporary in nature. We have understood that it is permanent, because you might have spent only rupees 1 crore, but you are eligible for 1.2 crore depreciation. The 20 lakh depreciation is earned by you not because of you spending it, but because of some scheme from the government, and that is permanent difference. So you cannot claim deferred tax asset on it. Another impact which generally happens in AS22 or in income tax is where you have this concept of funded gratuity. What exactly do we mean by funded gratuity? Under gratuity, we have an option either to have a separate fund to manage my gratuity, or pay as and when person leaves or quits. So what generally people do in funded gratuity is they will, on a regular basis, they keep investing money in a fund. And one of the important and widely used funds in India is Life Insurance Corporation. So that trader may take one insurance policy with LIC, and the objective is when a person leaves, I'll pay out of this insurance. How it will help him? He doesn't have to pay at one shot whole amount, and he is actually reducing his risk. On a regular basis, he is making the payment of insurance premium, and insurance will take care when a person leaves. So how do you treat this? Will this have any impact on your AS22? It will have, or it may have. The expenditure what you might have incurred in the year may be lesser than what amount you have spent or paid as premium. Under Income Tax Act, whatever amount you have paid as premium will get allowed as deduction. Under books, what do you have? Accrued will be shown as deduction. So those two things generally gives results in deferred tax. And again, the another important thing which we need to keep in gratuity is when we draw the income tax return for any assessee, or rather when assessee prepares the income tax return, please make it a point to see in the ITR P&L where have they shown the gratuity. Sometimes it so happens in income tax return you may have a concept called gratuity, funded gratuity, and if it is unfunded, but if you have disclosed your amount under funded gratuity, there are possibilities that you will get notice from CPC. That has to be taken care. Another challenge which generally we have seen is, imagine there is an entity which has two undertakings. One undertaking eligible for SEZ exemption, other undertaking which is in domestic tariff area. What I meant by two undertakings means one of the undertakings is a new undertaking, and they have applied, they have got the approval from SEZ, and whatever profit they make from that undertaking is completely exempted from the tax. The other is domestic tariff undertaking, which is providing services to the local customers here in India. So whatever profit that particular undertaking makes, they are liable for 30% taxation. But at a higher level, when you file the tax returns, or when you complete the books of account, these two divisions form part of one assessee, and income tax is also computed for that PAN. At that time, it is very important for you to have a proper breakup between the SEZ and non-SEZ. Of course, it is required under SEZ regulations also. You will have a separate disclosure, separate trial balance, and separate profit. And for the purposes of SEZ activities, you need to make sure you are not creating deferred tax asset on that. When you create deferred tax asset, assuming the balance sheet item is gratuity, the challenge which I have faced is when I get the gratuity certificate from actuarial, he gives the workings for all the employees put together. Imagine this scenario where I have few employees working under SEZ unit and few employees working under DTA unit. My closing balance of actuary or gratuity is sum total of these two. How do I compute deferred tax asset? That becomes a very big challenge. So what we need to do is take the bifurcation from the actuarial himself, how much is towards SEZ employees, how much is towards non-SEZ employees, and it may be advisable to compute deferred tax asset only on that portion which is for non-SEZ portion, because that is, we know it exactly what happens, and at the end of 5 years you will get to know what is the liability which is unpaid under SEZ, and to that extent you can recreate the deferred tax asset at a later date. Similar way, in these things there will be quite a few issues when an entity has multiple tax structure, multiple tax payment. Again, another thing which you need to keep in mind is, say for example, there is a entity which might have chosen a flexible tax rate. It may be two different tax rates applicable. Generally it may not be there, it is available for corporates. Generally, what, say for example, if a corporate entity has claimed or rather applied for section 115 BAB on the manufacturing activity, they are liable for 15% tax rate, and non-manufacturing but related to the main business, assuming they have some small trading, small income which is taxable as other income from other sources, that may get taxed at 22% or 30% as the case may be. So you need to understand how to allocate your tax rate between 15% and 30 or 22% and create your deferred tax asset. The next one being treatment in cash flows, very straightforward. When if at all you are doing it under indirect tax basis, it's always better you take the profit before taxation, and from there you make the adjustments for all the deferred tax assets or liabilities which has been given in the books of account. A couple of other case studies which I would like to take up here. This is a scenario where owners of H wish to recognize a material deferred tax asset in relation to the 250 crore rupees. So owners of H would they want to recognize material deferred tax asset to the extent of 250 crore rupees against unused trading loss which are accumulated as at 31st March 2021 or 2022 as the case may be. The entity has budgeted profits to be 80 crore in March 31st March 2022. We have a carried forward loss of 250 crore, and the current year the entity expects to make 80 crore profit. Entity forecasts that profits will grow by 20% each year. Means this year is 80, next year it will grow by 16 crores, so it becomes 96 crores and so on. The market is currently depressed and sales orders are at a lower level for the first quarter of 22. In the first quarter of 2022, there has been reduction, and this is what may be expected for future. H operates under a tax. In this case, can I claim deferred tax assets on whatever 250 crore carry forward trading losses I have? Now, first question, is it a deferred tax asset? Yes, it is a deferred tax asset because I have losses which I am eligible to carry forward. 2, am I making profit? Yes, this year I expect to make profit of 80 crore and I expect to make 20% profit year on year. There is a catch here. It has the certain things has happened and my profits have been reducing, and the H also very important to note here is H operates from a tax jurisdiction where losses can be carried forward for only 2 years. You may take 2 years, or maybe we can have it also as 5 years. So what should I do? As an auditor, should I allow them to create the deferred tax asset? If the carry forward loss is eligible for only 2 years, then whatever is more than 2 years losses which gets expired, on that there is no way you can create deferred tax asset, which is a straightforward case. Second case study is where the entity has leased out a machine. Many of these organization, instead of they buying the asset, what they do, they just take asset on lease, assuming they have created an asset on the lease, or maybe under AS 19 also they would have accounted leases under straight line basis. So what happens to deferred tax asset? Under income tax, even though under books of account you have this straight line basis or right of use asset basis on which you create your you account your books, but under Income Tax Act, what is allowed as reduction is actual cash outflow which you do for making the payment. Means 120 crore is your value of asset, I mean lease liability, or the total rental what I pay maybe 120 crores, which is over 5 years. So what I will do, I will allocate it over 5 years in the books. But under Income Tax Act, first year I am paying only 30 crore as rentals. Then what happens? Under income tax, only 30 crore paid is allowed as reduction, and deferred tax has to be created on the balance amount, and in the future it may get adjusted. So it is very important that these kind of leases you need to keep it in mind, and you can claim deferred tax only to the extent on which you are eligible to be carried forward. The third thing could be, say for example, one of your entities has given a profit portion for their employees, profit in the nature of shares, and they say if you continue with me for next 3 years, you are eligible for so much of shares, and I start accruing it based on the methodology which is given for entities. Income tax, it allows only when it is actually paid out. So here what happens, based on the intrinsic value during the vesting period, the entity may accrue expenses that could be only 1.6 crore, but actually when I end up paying them, if I value my entity at that time and if I pay them, it is at a higher amount. So what happens, whatever I had created as deferred tax asset before will get reversed, and what exactly I'm paying today will get allowed as income tax. There won't be any movements in the deferred tax asset per se, but whatever was created will get reversed and actual amount will get adjusted in the current year. Another entity, take for example, they have a temporary difference of rupees 50,000 and it has no taxable temporary difference, but there is an option, if at all they do some tax structuring, they are able to make profit of 60,000. And for creating that tax structure, they need to spend 12,000 rupees as expense. So on what amount should I create asset? Now the first question, do I have temporary difference? Yes, I have 50,000 rupees. Do I have taxable income which I will generate in the future? Yes, 60,000 income I generate, so asset really exists. On what amount should I create? It is only on that amount which is 50,000 minus 12, because 12,000 I should incur it. On the net amount only I will accrue the deferred tax asset. I need to adjust this 12,000 rupees from the difference and then I will compute the deferred tax asset. Another one may be, say for example, in the books of account, I am accruing income on a accrual basis, but as per income taxes, I give it on a cash basis. Say for example, the assessee has kept FD and FD interest is accrued every year, but the banker pays me interest only at the end of 4th year or 5th year. So what exactly happens under 26 years, interest will come, TDS will come only after 5 years. So generally, as what assessee does, he will also give for taxation, he will follow as per 26 years. In that scenario, there is a difference and you need to create deferred tax on it. Now the question is, what is the exchange rate? As on the balance sheet date, the tax rate was 30% and revised rate is say 25%. If whatever the revised rate, you will create on the revised rate. You will not create as on the balance sheet date. You do create deferred tax asset on the cash basis, but on the rate which is enacted. Few other things which needs to be kept in mind. One, assuming there was an acquisition and there was a goodwill in the books. Under Income Tax Act today, goodwill on acquisition is not allowed as a deduction. So if at all you have the goodwill in your books, effective financial year 2021, income tax does not allow depreciation on goodwill. So this will lead to permanent difference, and on that you cannot create deferred tax asset or reverse deferred tax asset. The other thing which you need to keep in mind, which generally we face challenges, assuming when two entities get merged, what happens to their deferred tax asset? Entity A and entity B are merging. Entity A had 10 crore of deferred tax asset. Entity B has say 50 lakh of deferred tax liability. Can I net off both? Generally in a merger, what happens? I'll add all assets, I'll add all liabilities line by line and arrive at the final balance sheet. But if there is a deferred tax asset and deferred tax liability, you need to go in depth to see whether these two things are adjustable, and then only you should create the asset or liability. Imagine a scenario where deferred tax asset was created in one entity because of carry forward of losses. Now that entity is getting merged with another entity. You know, to see whether that losses can be carried forward. If scenario tells that whatever losses which was created will cease to exist after the merger, then whatever deferred tax asset was created in the books shall be written off before you merge it with the new entity. So whatever deferred tax asset was created will get reversed. And forex fluctuation is again will have a bigger impact on AS22. Assuming you had a subsidiary which is outside India, or assuming you have transaction outside India, then forex fluctuation will definitely be there. And while doing that, say for example, your subsidiary you have consolidated with some exchange rate, and that exchange rate keeps on fluctuating, so your deferred tax also keeps on fluctuating. You should keep on revisiting this. And another thing which happens, assuming a trader or an assessee has revalued its fixed asset, there is a big impact on deferred taxes. Just because you have revalued your fixed asset, that amount will not be allowed as deduction under income tax. Under income tax, depreciation allowed is on the amount which you actually paid. So whatever revaluation you have done, that may lead to permanent difference, and you are not eligible or you are not allowed to create deferred tax asset or reverse deferred tax asset on that scenario. So these were the few things which I wanted to discuss on AS22. Hopefully I've covered major things. I also tried covering the practical aspects. If at all there are any questions before the next session, I can take it over. Are there any questions on this?
One question, I'll just share my screen.
Yeah.
Anyway, asking this one. Is my screen visible?
It's not visible.
No, you can click on the application, so it should pop up in front.
Yeah, okay.
Since your PPT is enabled, maybe that might be hiding.
Yes, whether for payment of deferred tax to be created. Yes. So one of the things here is MAT, whether if you are paid under 115 JB or if at all you are paying under say alternate minimum tax, assuming your tax rate is different. Under MA, you may be paying your MAT tax rate may be say 15%, but irrespective of that, when you create your deferred tax, you will create deferred tax on the tax rate applicable to you on a normal basis. Say for example, if your tax rate is 30%, when you create deferred tax, you will still create deferred tax on 30% and not under 15%. It is given as an explanation in the act itself, in the law itself. So please keep in mind, even though you know that next year you pay under MAT, which is at 15%, you do not know for how long you'll be paying under MAT. And MAT and income tax keeps fluctuating. So you will not be able to exactly project or predict what tax rate you will be when there is a reversal of that expenditure or reversal of the creation of the expenditure. So the law says create deferred tax asset on at the rate otherwise applicable to you under normal provision. It is not 15%, it is 30%, and you should create deferred tax.
Sir, so that was one question that came up, and rest were asking for the PPT to be circulated. So we'll be sharing it at the after completion of the session.
Yes.
So
Yes.
how do we go about it? So can we break for 5 minutes or so that you can refresh yourself? And
Yes,
then,
please.
please, I'll just put a break slide now, and you just let me know when you're ready. We'll start the session. Okay? I'm just putting up a break slide.
Sure. So now there will be around 5 minutes, right?
Yes, sir. Yes, sir. You let me know that you're ready. So then we'll start with the next session.
Sure. Done. Thank you.
Thank you.
Hello.
So are we good to go, sir?
Yes, sir.
So there's one question. I'll just share my screen. So this one. So is my screen visible?
Yes, yes. I'll share the worksheet later.
Okay. So I'll just can turn on a video. I'll just give you the presenter rights specs. Yeah, now you are made a presenter, so you can start sharing the screen.
Okay. Okay. So is it visible now?
Yeah, AS29 is visible, sir, but your video is not turned on, and
It's fine
yeah,
now.
now we're visible, sir. Yeah, you can. But you navigate to PPT. Yeah, now
PPT
PPT.
is also.
Yes, sir. Fine, sir. Thank you.
Okay. So can we start? Hello.
Please.
We can start, right?
Yes, sir. You can start, sir. Please.
Okay. Great. Thanks. So now we spent some time understanding about accounting standard 22, which is basically taxes on income. Now coming to accounting standard 29, which is the provisions, contingent liabilities and contingent assets. Even though the standard is so big, like, you know, by words, it is provisions, contingent assets and contingent liabilities. Generally, a layman, even many times when we talk, we say AS29, we connect that with provisions. Whenever we have to speak about provisions, we say AS29. As per AS29, provisions are done like so and so, so and so. So the provisions is something which is used multiple times. May not be that much we use contingent liabilities and contingent assets. Do we really require an accounting standard to guide us? How should we create provision? How should we disclose contingent liability? How should a contingent asset be displayed in various reports? While using the words, for one thing I say accounted, for other thing I say disclosed, for the third item I said displayed in different reports. So what I meant here is provisions is one which a person accounts in their books. Contingent liability is something which does not get accounted but gets disclosed in the books. Contingent assets neither gets accounted nor displayed in the books. Means, in simple terms, it go back to the original thing. To understand the logic here, why it happens like this, we should go back to our roots of accounting principles. You need to be clear when you create an asset when you accrue an income. On the other hand, for expenses, you should be prudent enough to create a liability. So that is the whole concept. And AS29 is very much important for the simple reason that the whole methodology for accruing provision is very important. There are issues as far as materiality is concerned, and the risks are more in provisions. And in general, as an auditor, we use the word estimation. The risk of material misstatement in books of account is pretty much high when there is an estimation which is involved. So as an auditor, when you draw your materiality, when you draw your audit procedures, you give higher weightage for those accounts which has an element of estimation. Whichever activity you do, whether you act as a GST auditor, whether you act as a internal auditor, whether you act as a statutory auditor, when you act as an income tax auditor, everywhere this provision has a direct impact. Why under GST? Again, there the concept of unbilled maybe there is an estimation involved. Why under regular act? Maybe you are accruing certain expenditure in the books of account, which if at all the judgment is wrong, that expenditure either may increase or it may reduce. When an expenditure either increases or reduces, that has an impact on the taxable profit, or rather profit in simple terms, profit. And this provision also plays an important role not only in tax audit and or GST, in also in displaying books of account. Let us take a scenario that an entity has borrowed money from bank, and one of the key factors or key indicators which decide on the interest rate may be how much asset they have, maybe how much receivables they have, there may be how much inventory they have and what profit they have made. And these ratios plays an important role for the banker also to analyze the repayment capacity or the ability to repay. Imagine a scenario where you are showing stock and a good amount of stock is non-saleable. Then asset will not give a true picture. You are showing debtors and majority of the debtors may be something which is outstanding for more than 90 days. You should have created some provision for bad debts. You have an asset which is given as a security, but that asset's ability to perform has been impaired. So all these words are based on all these activities are based on an important principle called estimation. The assessee estimates that inventory is value so much, assessee estimates that assets recoverability value is so much, entity estimates that debtors are recoverable to that extent. So everywhere the common factor here is estimates. And when there is an estimate, there exists judgment. When there is a judgment, unless and until your system is strong, your output may differ. So keeping that in mind, our AS 29 tries to guide the user and also the preparer of the financial statement to give a true and fair numbers, true and fair disclosures on the balance sheet or the P&L. Now, what is I explained the objective, I explained it, so that is very much the objective. What is the scope? What and all are included under AS 29? AS 29 includes all the provisions, the contingent liabilities, except generally our accounting standards are done in a manner. When I speak about an accounting standard, we'll say, okay, these are accounting standard includes everything except ABCD. So like that, similarly under AS 29, we have few exceptions. One, AS 29 does not apply where there is executory contracts or where there is an insurance contract or where the assets or liabilities are carried at a fair value. So to put it simple, AS 29 does not apply to the cases where you apply AS 7, which is percentage of compound for contracts, AS 9 revenue contracts, AS 15 employee benefits, AS 19 leases, AS 22 taxes on income. These are all the assets to be separately taken care, and any item which fall directly under 7, 9, 15, 19, 22, those items you cannot apply the principles of 29. Instead, you should go by each of those standard. You cannot apply the concept of AS 29 for gratuity. You cannot apply the concept of AS29 for, say, ESOP. You cannot apply the concept of AS29 for computing how much losses can be made in a works contract. So each and every standard has its own requirements. Definitions, certain things which we need to be aware of. In simple, all provisions are allowed and are explained under AS29 except few. Executory contracts are those contracts where either of the parties have performed only to their obligations or they are not performed anything else. So executory contracts are outside the principles. A provision is a liability which can be measured only by using a substantial degree of estimation. During the background, I said the most important thing here for anybody in any financial statement is estimation. A provision is that element, that item which has the maximum quantum of estimation or judgment involved in a financial statement. On the other hand, liability is nothing but, there's a difference between a provision and liability. Many of the times when I do the audit, when I get to see the financial statements, I see that the accountants will use the word provision and liability as mutually interchangeable. The fact is no. The moment I say provision, it has to be only those where there is estimation. Liabilities are, on the other hand, are those where there is no estimation. There is a liability which is being created. You know what the value is. So there is no question of estimation in liability. Restructuring is something. Why should we talk about restructuring? Restructuring is, again, the cost towards restructuring is part of AS29, and I'll be taking few practical scenarios at a later stage where you will understand more about restructuring. Now you have to just understand restructuring is that activity where management decides to make certain changes to its operations, which can either be that they try to change the nature of activities which it is undertaking, or the way in which the business was conducted. They want to bring some sort of modifications to the organizations and operations. So that is called restructuring program. On the other hand, contingent liability. How is a liability, how is a provision or a liability different from a contingent liability? In contingent liability, what happens is there is an event, but there is a past event. Something has happened in the past, but the existence of that is correlated, or it's not, it's dependent on some other event and the happening of that other event or not. To put it very simple, there is an obligation. Say I have done some transaction, and on that transaction there is a pause. Someone has filed a litigation. Say, for example, I had sold a product to my customer. The transaction has happened and customer has faced some peculiar challenge out of it. Let us say, for example, I had sold plant equipment, and equipment was supposed to work for 18 hours a day, and have done the testing. It was working for 18 hours a day. Later on, when it goes to customer, for some reason he starts a litigation. He starts to tell this item is not up to the mark. It is working for only 14 hours a day. And he tells, since it is not working for 18 hours a day, there is a gap of 4 hours. Because of that 4 hours, I am losing X amount of profit. And he litigates against me in the court of law. So in this case, what happened? The transaction between me and my customer has happened before. One, that is a past event. My liability to him depends on what happens in the court of law. If court thinks that my equipment has a faulty issue and because of that it is not operating for 18 hours, and hence he is the customer is facing challenges, then I may be liable to pay some consideration. I may be liable to make good the losses of his. On the other hand, if the court feels that the issue is not with the equipment which I have sold to him, instead it is because of some methodology he is adopting. He may not be using a proper raw material, the power supply is not strong enough, the related machinery, ancillary machinery what he is having is not up to the mark, and hence the system is not working for 18 hours. If at all the court decides that, then what happens, the case will, I will win the case and I don't have to pay any penalty, or I don't have to pay any consideration to him. So in this case, my liability to my customer depends on what decision the court gives, what decision the judge gives. So in that, whatever the judge decides is not in my control. It is neither in my control nor in my customer's control. It is totally outside my control, and hence it is called a contingent liability. Contingent asset, on the other hand, is again something which has happened. I had done something in before, something has happened in the recent past, and that gives a kind of evidence that I will get some asset out of it. Say for example, I had sold my property to the government, and government had fixed some price and they had paid us that price. Later on, some amendment in the law happens with the government, and as per that, the consideration which was payable to me, say it gets increased. In this case, what has happened, I had made the sale, I had received the money also, but some modification which happens at a later stage where government tells, rather that regulator, I would say the court tells the regulator to pay me more. Against that, the regulator goes on an appeal and he says, no, I will not pay, and he will go to the court. So here basically what is this? I have got some evidence to say that I may get some additional consideration, but there is no assurity that I'll get that much of consideration. So this is basically an asset which is contingent in nature. If the court tells that it has to be paid, and if this guy also agrees, then only it comes to me. Until then, it is not mine. So I don't even disclose that. Present obligation is nothing but whatever I have agreed as on the date, I have agreed, and it is very much sure that it is going to happen. When do I recognize provision? Three conditions are very, very essential for me to recognize provision. One, the entity should have present obligation because of the past event. I should have done something, some transaction has happened and I have completed that transaction. Second, it is probable that I should pay him something. There is an economic benefit involved. And the most important is I know how much I should. There is a reliable estimate. If I know 100% how much should I pay, that becomes a liability. I do not know 100%, but there is a reliable estimate. I know the charges may be between 55 lakh to 65 lakh. In that scenario, these three, see, basically say for example, I have I would say I have taken a consultant on roll, and I have told this consultant you need to work on a particular project, and that project is completed say around 40% to 50. I'm not able to exactly tell what percentage it is completed, and based on that my liability to pay him arrives. So he has performed his obligation. I know that I need to pay him, but I do not know whether I should pay him 40% or 50%. I'll be able to tell whether it is 40% or 50% provided he completes one of the important tasks. There are 4 tasks, 3 is completed and he is in the verge of completing 4th. And if he completes 4th, then I get to know, okay, this is the obligation, this is what the final number is. If the 4th thing does not achieve, if the 4th thing does not give a proper result, he may have to do something else. So there is a quantum of estimation which is involved. In that scenario, I will still accrue some amount based on my past. That is called provision. Past event, as I explained, this is something where an obligating event has been done. Financial statement deal with the financial position of enterprise at the end of its reporting period, and it is not based on the future. Means for any liability to create, for any provision to create, the event should have happened in the past. I cannot create a provision keeping in mind what I will do in the future. Say for example, I know the fact I need to employ an advocate for a particular activity, and I employ the advocate also. He has not even visited the court for the case which he has been appointed for, but I know the fact total I should pay him say 5 lakh rupees. The agreement, the purchase order, the letter of engagement, everything is signed, but that event which kicks off the transaction has not happened. I have just spoken to him. He has to go say in the month of June. That to pay that will arise only when that event happens. The event is yet to happen, so I cannot accrue the provision for it. I cannot accrue the liability for it. Hence, what I am trying to tell here is the only liability recognized in the balance sheet are those that existed as on the balance sheet date. There has to be some event which has existed as on the balance sheet date. Only on that I'll be eligible to accrue. I'll be liable to accrue provisions. Second, there has to be a probable outflow of resources. If outflow of resources is not probable, means to say that the possibility that I pay should be more than the possibility that I do not pay. So that is very important. Where the probability that a present obligation, the probability is not strong enough, if the probability is remote, then I will end up creating a contingent liability and not a provision. Reliable estimate is very important. I should have enough documentation. How do you arrive at a reliable estimate? One, based on your past experience. Two, based on experts' opinion or report. Those are the two basic things. When I need to say, for example, assume I need to accrue liability for warranty. I may not be able, I will do it based on how the sales has happened in the past 5 years. How many cases there were challenges in changing materials. I had to change the materials. Based on that, I will accrue warranty. Say for example, there is another scenario where in simple terms, if I tell inventory obsolescence, I go to an expert whom I will ask, please tell me what could be the saleable value of this inventory. And he gives me some analysis and he tells me this is how the sales happens, and as per that I create provision. So I have two options. Either I go based on my past experience or I will go with some expert advice. If I'm not able to create that reliable estimate, then my whole disclosure will be as a contingent liability and not as a provision. Now, what is contingent? I explained severally. Contingent liability means event has happened, but the trigger depends on an event which is uncertain as of today, which may happen, which may not happen. In that scenario, basically there is no reliable estimation. When there is no reliable estimation, you will just disclose it as a contingent liability with a good explanation. You will mention this is an event which has happened, which may result in me making the additional payment, and these are the reason why I feel I do not have to pay additional amount. The biggest examples could be any litigations for income tax, any litigations for indirect taxes, any litigations of receivable. All those things will come, payable will come under contingent liabilities. Contingent liability, and again there could be cases of jointly and severally liable, and as an entity I make provision or I create contingent liability only for that portion which I'm individually liable for. All these contingent liabilities very important. Year on year I need to keep reviewing what is happening in my status. Till last year there were no proper estimation. If in the current year, if I have received some evidence, then I will have to rework on that. There are possibilities that a contingent liability will move from the status of contingent liability into a actual provision, or maybe sometimes actual liability also. Contingent assets I explained, so that I'll shift. Okay, these are the three things where we will decide whether an liability, whether an expenditure is a provision, or whether an expenditure is a contingent liability, or it's something different. There is a present obligation that probably requires an outflow of resources, and a reliable estimate can be made of the amount of obligation. Then it is provision. There is a possible obligation or a present obligation, but probably will require an outflow, will not require an outflow of resources. At that time, I don't even make the provision. I'll just show it as a contingent liability. There is a possible obligation. However, likelihood of an outflow is very, very remote. I will not even create a provision. I will not even make a disclosure. Measurement, best estimates is very important. All these provisions, whatever we make, we cannot discount, and the whatever provisions we create, there is an impact on the accounting standard 22. Why? Because this provision generally gets disallowed under Income Tax Act, and you may end up creating deferred tax asset. And this has some, I explained in the past slides, judgment is involved, so our assertions should be strong, our audit procedure should be strong to make sure assertions have been complied. Risk and uncertainties in all provisions, there is a huge risk. There is a good amount, I don't call it as huge, but there is a good amount of risk and good amount of uncertainties. Whenever making judgments, caution, you need to be, the assessee has to have enough data with him. Just because there is an uncertainty, you cannot create a excessive amount of provision. That will not, there has to be a deliberate review of the system. Just because there is an uncertainty, you cannot give either a higher provision or you cannot do a lesser provision. Future events are very important. What can happen in future? Many times what happens, I create a provision based on what is happening today. I should also keep in mind how things can change in future. If there is a change in the technology which will give additional information, which will reduce my, assuming I'm in some technology business where, rather I'm in some business where today I'm spending X percentage of my revenue as cost, and with the technology coming in place, my expenses will reduce. And whatever I need to spend on relocating my asset or overhauling my asset also will reduce. So I need to, for whatever amount I create as asset retirement obligation, I should keep these future events in my mind, and based on that, I'll have to compute my liability. Asset retirement obligation, I have to just, I will take some time to explain this. Say an entity has started its operations from a leased premises. Say they have spent good amount of money on assets. Lease rental they are paying month on month or year on year. The landlord has clearly said, I will give it on lease to you, and when you give it back to me, it has to be in the condition the way I gave it to you. Means what? I would have spent on civil construction of that lease, on that building. I would have spent money on changing the way it is totally being used. Maybe I would have taken one shell component. I would have built lot of walls in between. I would have created, I have created a pedestal for keeping my plants. And after 10 years, when I leave, I should demolish all this, repaint the entire structure. If at all some structure is changed, rebuild those structures and give to my landlord. So what exactly I'm doing here? At the end of 10 years, I'm refurbishing the whole asset in a way it was handed over to me when I entered the premises. For that, assuming I need to spend around 25 lakh rupees. I and I know that I have to spend it after 10 years. So what I should do, I should create that much of liability today so that at the end of 10 years, I'll be able to spend that money. This amount does not arise because at the end of 10 years, but it arises the day I have taken the asset. So I create that liability today itself. And this is called provision for asset retirement obligation. Next, expected disposal of asset. If at all if at all I know that there is an income which I will earn by disposing an asset, can I create that gain today itself? Answer is no. As we all understood, any income can be accrued only when I'm sure that I recover it. So this income also I should wait until I get evidence to say yes, I have earned it. Reimbursements, again similar way, reimbursement what I need to recover. If I need to incur expenditure, I will accrue it as per provision, but I need to recover something, I'll wait until the evidence there exists a 100% certainty that I will be able to recover the money. Changes in provisions year on year or every reporting period, a changes in provision keeps happen. You need to keep updating your provision schedule, add, reduce, reverse, all those things will happen. One important thing which needs to be noted is never consider this provision as a pool. Never consider provision as one differential amount. Means to say, many times it happens, someone just creates a provision of 5 lakh rupees and without even bifurcating for what items it is. It is very important that you have a bifurcation. One may be provision for retirement benefit, one may be provision for warranty, one may be provision for sales return. Each of these things you need to allocate separately. If provision is just one single bucket, you will not be able to accept it as an auditor, and you need to have the breakup for each. And there may be chances that provision for warranty what you accrued is lesser, provision for sales return what you have done is more. You cannot say I will set off both. You cannot do that. Adjustments to sales return has to happen specifically to sales return provision. Adjustment to warranty should happen specifically to the warranty provision. Future operating losses, even though I know the fact, we have just discussed all expenses I should accrue. Now the question is, should I accrue for future operating loss? I know the fact that the activity which I have taken, I am entering into an activity where I'm going to definitely incur losses. I know that. Can I create that liability for it today? Answer is no, you cannot. But the only exception is if it is an onerous contract. What do you exactly mean by onerous contract? You have entered for a sales transaction with one of your customers where you cannot cancel the contract. Say you have entered into building you have entered into constructing a building. When you start constructing a building, you expected iron rate of steel should be so and so, rate of cement should be so and so amount, and you have to complete within 3 months. The moment you enter into this contract, the Russia-Ukraine war starts, and because of various other things, the cost of these components will increase multifold times. The cost of steel increases by say 200 times, the cost of fuel increases by X amount, and which makes you realize that no matter how much ever reduction you do, you are going to incur losses for sure. Just because you incur losses, you cannot go and cancel the contract. That's also very much sure. And in this case, what you should do is, you have no option, purchase at a higher cost, sell at a lower cost, and incur losses. This is called onerous contract. Only in onerous contract you create provision for losses, and not for the cases where you have not even started the activities and you are sure that you are going to make losses. What I'm trying to tell, what do you mean by future? How is onerous contract different from a future operating loss? In onerous contract, you have signed the contract, you know that this is the revenue, and you have started working on it, and against that you also know what is the cost of product. So there is a loss. Future operating losses means it is a scenario, say you are into e-commerce activity and you know for next 3 years you are going to spend 30 crores, 40 crores and 50 crores. Totally 120 crores you are going to spend. And 100% you know the total revenue what you are going to make cannot be more than 50 crores accumulative. So you are ending up with a 70 crore net accumulated loss. That you cannot account it now as a provision because that event has not happened. And there are possibilities that you may decide after second year to stop your business, or you may find out something better where that will turn around your business and you will start making profit. So these are the case. This is how we differentiate between an onerous contract and a future operating loss. Restructuring cost, again, should I accrue a liability for restructuring? Answer is yes. Restructuring is an activity where the management decides to revive the operations or change the operations, and for doing that it decides, okay fine, I will sell this many assets to you at so and so cost and I will incur this much of expenditure, or I've decided that I will shut down my operations and I need to pay employees this much of ERS. So this is a case where expenditures accrues to me because I have finalized the deal. If deal is not finalized, then it is not a final, it's not exactly a restructuring and I don't have to accrue the liabilities. So this I'll just disclosure wise, coming to, of course, for a couple of level things, disclosure, complete disclosure is not mandatory. Nevertheless, having a proper disclosure is advisable. How we do? All opening balance of provision we should show. Movements during the year, how much is incurred, how much is reversed, how much is paid, we should adjust, and closing balance we should show it separately. Same way ICDS also tells movements we should disclose. Whatever is accrued during the year gets disallowed under Income Tax Act. Whatever is actually paid or reversed gets allowed under Income Tax Act. Couple of case studies. I would like to take a few case studies. Is provision same as depreciation or impairment and doubtful debts? In impairment also there is an estimation. In depreciation also there is an estimation. In doubtful debts also there is an estimation. Can I say these are all the provisions? The answer is no. Just because there is an estimation, it is not provision. Provision results in a liability and I need to pay in cash. These are depreciation, impairment, doubtful debts are actually reduction in the value of asset. Whatever asset I had, in that there is a reduction. So there is a difference between provision versus impairment, provision versus depreciation, provision versus doubtful debts. How does this provision impact my IT computation? Whatever amount I show it as provision, 100% it gets disallowed under IT. The moment I say provision, it will lead to a case of ad hoc. It is done on ad hoc basis, means to say that expenditure is not incurred. There are various case laws which says provision needs to be allowed, but there are also equally stands saying a provision should be disallowed. For example, warranty. If a warranty is made under Income Tax Act, it has to be disallowed. But the case law says if warranty is based on some scientific approach, then it can be allowed. So what the differential factor here is, to what extent your estimations are good enough. If estimations are good, you can substantiate, otherwise it is difficult to substantiate. Gratuity, leave encashment, either ways this disallowed under income tax, section 43B or 40A7. There are a few other examples. How do we treat? Can I say that electricity, gas, what happens generally as on 31st March, electricity bill or power bill has not come to me. It comes on say 5th or 7th of April. what should I do in the books? I should accrue some expenditure. Can I call this as a provision? Answer is no, it is not a provision. There is no much estimation involved. You are getting a better evidence immediately after the month end, and you know how the electricity usage has been. You know what is the electricity rate, and if you are aware that I have used X number of percentage and the value is so much, I create the liability. So it becomes a liability. It is not provision. Amount payable for goods received but not invoiced. Is that a provision? Means I have purchased materials. It has reached my godown or warehouse, but vendor has not transferred the invoice. He has not updated either his GST return or he has not shared invoice to me as on 31st March. He does everything in the subsequent month. Can I call it as a provision? Answer is no, because in this case, I know how many units have come, and I also know what is that amount which I need to pay for each of these units. There is a purchase order, there is an agreement between me and my vendor, wherein it specifically mentioned these are the things which you need to, these are the amounts which you need to pay. So since I am 100% sure as to what my outflow is, at that scenario, there is no estimation involved. When there is no estimation involved, it is a liability and it is not a provision. Financial guarantee given by a parent to its subsidiary. Subsidiary wants loan, so parent gives a financial guarantee. Is it a provision? Answer is no, it is not a provision, but it may be a contingent liability. Warranty obligation, I have made sales and I have told them that 1 year warranty I give to. Anything happens for 1 year, you come to me, I will rectify and give it to you. At that time, I should make a provision. I should create a liability provision based on my past experience. I will see, okay, last 5 years I have been selling so and so, so and so. When I sell this say equipment, the error may happen in a motor, error may happen in say one particular electronic tool inside, and only for those things they come back. The possibility of they coming in 1 year is so much, possibility of they coming in 2 years is so much. I do some weightage and then I accrue liability. Here I should accrue liability because it is on a mutual, you know, what do you call, matching concept, and that liability what I have accrued is falling under the definition of provision because there is an estimation involved. I do not know exactly how many people will come back. I know probably this many people will come back, so I create a provision. Hence, it is again it falls under the definition of provision. Accrued interest payable on borrowings. My interest cycle is from 14th of a month to 13th of subsequent month. In between comes March 31st. So I have not been debited by the lender, but I know how much interest it is because I know what is my loan outstanding. I know interest rate is say around 10%. Loan outstanding is 1 crore. On 1 crore, 10% is say 10 lakh rupees is my interest liability, but I need to amortize it. I need to allocate it. There I know how much I should pay. There is no estimation involved. Hence, accrued interest is not a provision. It is an actual liability. Unearned revenue or advance received from customer. What happens? I have accrued, I have given my services, but I have not raised an invoice. Many times it so happens until and unless I complete X percentage, I will not be eligible to raise an invoice. Under AS9, if that can be considered as a percentage of completion, then I will account revenue to that extent. So this will not come under provision, but it goes under AS9. Provision for inventory is basically a concept where if inventory is not moving for very long or inventory's life has been tarnished or the technology has changed or the demand has reduced, I may have to create provision for inventory's recoverability. I know the technology has impacted my inventory. I will have to sell inventory at a price which is less than the cost. It is below the cost, or it is you know, its recoverability has reduced. Then I create provision. Here what happens is there is a possibility that I'll be able to sell, but there is also a information available which tells me, boss, it may be difficult for me to sell at a value lower than this. There are few evidences that I'll be able to sell above cost, but there are equal other evidences to say that unless you reduce your cost, you will not be able to sell. So at that time, in the absence of complete information, I accrue some provision just to make sure my assets are not overstated. So the next one, say a couple of case studies. What happens is whenever I create a provision, the definitely goes and sits in the balance sheet. The corresponding thing could generally be to P&L. I create a provision for warranty, debit P&L, credit balance sheet. I create a liability for sales return, debit P&L, credit definitely the receivables. Sometimes this can also get into an asset. Say for example, I have created provision for some expenditure which is actually being used to create an asset. And at that time, for example, asset retirement obligation, which I explained you in the past slide. This is a liability which I need to pay at the end. But what I do, I will capitalize it to my asset and I will amortize over a period. That's how it happens. Should provision be recognized for cash refunds or sales return? Yes. I explained we need to create provisions. Accrual for sales return is again a provision. What should be done when there is no reliable estimate that can be used? If there is no reliable estimate, please don't create provision. Keep it under contingent liability. Substantiate the background of contingent liability. Explain why you could not create provision, but you are kept under contingent liability. While accounting for a recognized provision, undergo a change once the amount payable under the obligation becomes certain. Yes, of course. Last year I had created as provision, and subsequently it so happens I get additional evidence, and that evidence leads to its actual liability. So it becomes a liability. Onerous contracts, I explained. Another case study here, an entity has a reporting date as 31st March 2022. It intends to repair an item of plant during next year. Cost has been reliably estimated. It's very much reliable that 10,000 I'm going to incur. However, when I actually do it, it becomes 12,000. So what should I do? Is the amount reliable? Yes, it is reliable. Has the transaction happened? No, transaction has not happened. It is going to happen in the next year. So even though you know that how much you are going to incur, we cannot account it because the transaction should happen. And when the transaction happens next year, you will accrue during next year. Assume a scenario where I'm working, I have a plant, and in the plant it has been made mandatory that I should have smoke filters. And my reporting date is 30th June, and I should make sure that filter is implemented by 31st December 2007, or rather 20, whatever the date it is. Should I create a provision? The answer is no, because whatever I have created, whatever expenditure I've incurred, I will account it, and whatever is yet to incur, whatever is yet to happen, I have time till December, and I will account it by December. Imagine a scenario where I am a dealer in machines, and I tell my customers, you can sell the, you can come to me after 3 years, get the same equipment, whatever you have bought. I will sell a new, I will give a new asset with X percentage of discount. Basically, what's happening? It's a case where there is an exchange offer. You will be seeing a lot of these offers, and I'm going to give discount for him when he gives his old equipment to me. There again, what I will do, I need to analyze in how many cases those buyers will come back to me to exchange. I will make an estimation, and that estimation, whatever I will have to give a refund, or if I have to give a discount at the end of 3 years, I'll start accruing now itself, and that again falls under provisions. Entity XYZ is engaged in manufacture or sale of items. Sale of item is subject to a warranty. Warranty I explained. I think this is also fine. Entity A has entered a contract to purchase specific. This is important one. A has entered into a contract to purchase specific quantity of alloy at the rate of 50 rupees for a period of 3 years. contract is not cancelable without payment of component. There is, unless you pay component, it is not cancelable. Now what's happening? Current market price of alloy is 45 per unit. Alloy is purchased for a consumption during the manufacturing process. So there is actually market price is reduced, but I have an agreement that I should pay only 50 rupees to him. So there is 5 rupees loss which I am going to incur. In the sense, if I had not had this contract, I would have got product at 45 rupees. But even though I'm getting at 45 rupees, I could have bought it at 45 rupees. I'm paying 50 rupees. Is this 5 rupees a loss which I should incur? If you read it continuously, even though if I buy it at 50 rupees, I'm going to make profit when I sell my final product. Of course, there is a 5 rupees opportunity loss. I could have made profit higher by 5 rupees. But because I have a contract which I cannot cancel, I'll end up paying 50 rupees. This 5 is not actually a onerous contract because at the end I am making profit. So it will not fall under onerous contract. Say imagine another entity which generally happens. They are manufacturers of equipments. Customers have approved the equipments and have made the sale. But the sale will be complete only when the installation happens at the client location. My equipment has gone and all the materials have also gone. That takes, I know that it will take 6 months to install. And the total contract value is at 20 crore. I know that after 1 year, while at the time of installation, I need to spend some money on travel cost. I need to spend some money on labor. I need to spend some money on, say, materials. Revenue as transaction has happened today. Can I create provision for these items? Answer is no, because the transaction should happen. Since the transaction has not happened, even though I know the fact, I cannot create liability or provision for it. And these are the basic examples which I felt I should share with you all. These are things which I have come across in my practical experience. And if at all you have any specific question, I'll be more than happy to answer. The whole thing here is, how do we decide what is provision? How do we decide what is liability? And how do we differentiate between a provision and liability? That is what we understood. Any questions, please let me know. I'll take it.
Yes, sir. I'll just share my screen.
Yeah.
So one question. This one.
1 second. Yes. In the assessment order, contingent liability disclosed in Form 3CD as disallows under 43B, stating that there is an inconsistency between Form 3CD and ITR. Since the contingent liability shown in Form 3CD isn't declared as income on ITR, AO called for a response to the proposed adjustment. Assessee had clearly that contingent liability hasn't been claimed. However, AO was, sir, sorry, sir, I'm not able to understand. Can you just explain this?
No, so it just came up long back. I'll just check with the participant. Yeah. So Suresh, I'll ask him to unmute. Suresh, sir, if possible, can you unmute and the person who has raised the question is online only, sir, and I've asked him to unmute. We'll see. If not, so we'll. We'll ask him we'll share the question for the explanation. You can explain it over mails if possible, time permits.
Yes, sir. That's fine. That's fine, sir.
Yes. So this is one question that came up. No more questions actually. Many were asking for PPTs only.
Hello.
And
Hello.
So
hello.
Otherwise, over to you, sir, for a vote of thanks.
Hello.
Yes, tell me, sir.
Hello.
Sorry, sir. Yes, tell me, sir.
Can I ask the question?
Yes, sir. Please.
Can I explain the question?
Please,
Yes,
please.
please.
Is it okay for the speaker?
Yes,
Yeah,
Yes, sir.
please.
Yes, sir. Please proceed, sir.
Yeah. This is a case of a company SSC where in the statutory audit report on the notes to accounts, contingent liability has been shown clearly. It is a service tax demand which has been appealed and it is pending before the appellate authority. And it has been there since 2010, financial year 2010-11 onwards. And every year this has been shown as a contingent liability in the notes to accounts as well as in Form 3CD. In Form 3CD,
Why Form 3CD, sir?
in Form 3CD, there is a point, I think it is point number 21, where they have asked for particulars of contingent liability.
It is, the word is not contingent liability in Form 3CD. Any expenditure is contingency in nature.
No, but details of contingent liability.
No, it is any expenditure which is contingent in nature. Please go ahead, sir. That's how the word used. There is a guidance note on 3CD. You can refer to that. The wording used is expenditure which is contingent in nature. The whole objective of that clause is you have debited some expenditure into the P&L which is more contingent in nature. That needs to be disclosed separately. It is not the contingent liability what comes under AS 29. Yes, sir.
So
Please go ahead, sir.
So this was disclosed, I think it is under say point number 21 of Form 3CD, where point number E or E, I think, where the particulars or disclosure of contingent liability is asked for, where the contingent liability has been disclosed. It has been disclosed ever since 2010 onwards. But in the financial year 2019-20, the AO prefers to adjust this, saying it has been shown in the Form 3CD, but it is not shown in the IT return as an income. So he proposes an adjustment to add it. In the response to the proposed adjustment, the assessee has very clearly given that it has not been debited as expenditure in the P&L account. It is purely a contingent in nature. But in spite of that, the AO goes ahead and adds this contingent liability of 6 crores and raises a demand of 2 crores on that. And now, actually in the financial year 19-20 assessment year 2021, this has been added. But fortunately or unfortunately, in the financial year 18-19 itself, the ST80 order has been passed, which was not in the communication between the assessee and the auditor. So actually 1 year prior to that year itself, the liability has been clearly set aside by the tribunal of ST80. But so the contingent liability disclosure continued to be there in the next 2 years also, 1920 and 2021. But the AO has added this. Is AO right in adding this? Or what is the mistake in the part of Form 3CD?
Yeah, so
there are sub questions to this, but this is the main question.
No issues, got it, sir. So on a prima facie, this is not a AS29 question, but nevertheless, I'll try to answer this. One, as I told before, the clause which is required under 3CD, it talks about expenditure which is contingent in nature. If that is the case, you need to, as a tax auditor, auditor has to mention in the 3CD. In this case, I think, in my view, it was not debited to P&L. It was shown under contingent liability under AS29 as notes, but maybe by maybe it could have disclosed under 3CD. It could be a mistake. And the moment it is there in 3CD, obviously, it will initiate an action from the AO. And I think since you said it is 2010, at that time, you never had this, the whole system of CPC comparing your ITR vis-a-vis 3CD would have gone. But today, if it goes, automatically it gets disallowed. Rather, the differential intimation you will get as to why I should not add it back or I should not adjust it. You will get it immediately. The whole activity of disclosing there, in my view, is right. But you need to litigate, rather it's a error in 3CD. it was not a debit in P&L, but it has contingent liability disclosed there. You need to litigate with the officer. You may have to file for rectification of 3CD. There is an option to rectify 3CD. You may have to file for it, or if that is not going to happen, substantiate with the assessing officer this which was never debited to P&L. If something was debited to P&L, you cannot disallow for an error which was made in one of the forms, and you will have all the possibilities of winning the case. And since in your case it is also a fact that the lender has kept aside the order, that itself shows that there exists no contingent liability. Nothing has to come to P&L, and the case should be closed in that manner.
Okay, sir. Thank you.
Yeah.
Hello.
Yes, sir. Yes, sir.
Yes, sir.
I don't know. Can I still deal on Form 3CD, or this is not your subject?
Please go ahead,
Because
sir. If possible, I'll answer, sir.
Yeah. Now, can the auditor who is responsible for the disclosure in Form 3CD, for that matter, I am the auditor, okay? And can I admit as an error in my disclosure in Form 3CD, what are the consequences of that accepting the error in Form 3CD by the auditor vis-a-vis the department or vis-a-vis the disciplinary committee in the C Institute?
Okay.
By saying it's an error of disclosure in contingent liability, and it is purely a contingent liability, it is not debited to P&L account as expenses.
Yeah.
But by admitting an error in Form 3CD, what are the consequences?
See, consequences, I may not be able to comment what could be the consequence from the discipline committee, but income tax portal allows you to revise 3CD for specific years. You need to see whether you are allowed to revise it. And once you revise it, the assessee has to file for rectification, or rather refile for the ITR purpose. There is an option where you can request the CPC to revisit whatever the ITR. Now what they do is, vis-a-vis 3CD, ITR can be reconciled. Now the 3CD is rectified without any contingency. ITR and 3CD matches, and assessing officer will accept it. Now from the disciplinary committee, I really don't know what will happen. I don't see any major impact, because unless there is a professional, someone has not put professional intelligence over there, he has not been has not taken it seriously, and something erroneously has come, then there could be an issue. If it is a case of you have done your work, but because of some reason it has come disclosed there, again goes with the institute, that is maybe difficult for me to comment. From income tax, it can be reconciled.
Okay. Okay.
And
sir.
I do not know you can revise 2018-19 3CD. I know that I think you have an option to revise 2021. Earlier to that, I doubt you can do it.
Yeah, but we have filed a rectification petition under section 154, disclosing all these points to the assessing officer, and we are also preparing for an appeal, for going on appeal.
Yes, sir, that's the only option, sir, because it is 2010 where you never had your online, I guess, or I don't know, there may be online also. At this moment, it may not be possible.
This is for the financial year 1920.
1920. Financial year
Financial year 1920, assessment year 2021.
Okay.
The
Just see,
addition is made.
Yeah. Since you already gone and litigation, you have to close it there only, sir.
Okay.
Yeah.
Okay, sir. Thank you.
Sir, thank you.
Thank you.
Thank you, sir. Thank you.
Thank you.
Thank you so much for our interesting presentation. And though it is a program on accounting standards, you have presented very interesting way, and I hope every one of our members enjoyed this session. The way in which you presented this paper shows that your interest, passion towards this topic. My sincere thanks to you, sir.
Thank you.
I request you to continue your good works for the betterment of the profession. And I thank every one of the members spending valuable time for today's this excellent program. and we will meet tomorrow with a more interesting session for the relating to the accounting standard for the non-corporate entities. Thank you, Selva, for your dedicated and committed work for the SIRC. Thank you. Thank you, everyone. Thank you.
Thank you all.
Thank you, sir.